Hey everyone, Coach Investor back to another video for today. So let's talk about SoFi. The stock has had one hell of a start of 2024. And I said the stock, not the business. Very important distinction to make right now because the analyst from, by the way, a boutique firm who has put a $6.5 price target. Why is that? Why did he decide to do that right now? Well, basically, if you go through all the note, basically it's because the stock has gone up too fast. Stock was at $10 or so, which by the way is a resistance point. We're going to have a look at that later in this video. Stock has gone up too fast. Interest rates will come down. That will hurt the company, which by the way, before interest rates staying too high for too long was also going to hurt the company. So which one is it? Is it interest rates staying up for too long is going to hurt the company, or interest rates coming down is going to hurt the company? You can't win here if you're SoFi. Remember, when they said that the student loan program will be paused, they said, oh, this is going to hurt SoFi as well. What has happened since then? What has happened? Well, management has continued to execute perfectly. The business has continued to grow, and they have continuously beat the expectations. I think the last X amount of quarters, double beat, if not triple beat. So, yeah. I didn't quite understand, but okay, the market did what the market did. Stock crashed around 30% or so. But SoFi, the business itself, had a couple of announcements this week. We're going to have and talk about the note in just a bit. But first of all, they announced this, means calling it quits. We're not going anywhere. So continue managing your finance and more with SoFi. Get net worth tracking, credit score monitoring, spending breakdowns, financial insights, and more at no cost. So Mint is shutting down January 1st, so it's already gone, which means some of the users there are up for grabs, and SoFi are right here with a good marketing campaign. Then they announced this, get a 2% IRA match, tax season is now match season. Turn tax season into something you actually look forward to. With a 2% match on all your SoFi IRA contributions, offer lasts through tax day 15th of April 2024. So you save towards retirement, plus you get an extra 2% for every dollar you put in. And to top it off, funding your IRA may reduce taxes. That's a pretty sweet setup. Now, I believe that with SoFi specifically here, you're getting SoFi points, if I'm not mistaken, unlike with Robinhood where you get the money directly. I think here you're getting the SoFi points. If you're a SoFi user, do let me know down in the comments below. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. We're trying to reach 40,000 subscribers in 2024. That's the goal. Let's try and reach that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So this is basically SoFi right now. It has a market cap of $8 billion, forward PE 31.2 times. Last year, stock went up 76.52%. Stock right now is at $8.36 pre-market. And this is basically what the analysts are expecting in the next fiscal years. Sales growth for fiscal year 2024 of 22.7%. EPS of 12 cents. This is adjusted EPS, by the way. Then for fiscal year 2025, sales growth of another 18.24%. And EPS of 31 cents, which represents 151.36% year-over-year growth. Which brings me to the average analyst price target for the next 12 months. Currently, the average sits at $9.53, representing 13.2% upside. Now, with regards to that analyst note, let me redirect you to this page right here. So, the analyst from KBW, Mike Perito, downgraded SoFi shares to underperform from market perform, warning of a premium valuation and potential pressure stemming from lower interest rates. He cuts his price target to $6.5 from $7.5, with the new target implying 33% downside. Of course, stock already crashed 13% since then. Perito noted that SoFi stock got caught up in the relief rally following the Federal Reserve mid-December signal of possible rate cuts in 2024, but he questions whether that enthusiasm is warranted. SoFi is actually at risk for down earnings, at least initially, if rates come down materially due to its fair value accounting. Longer term, the bank's cost of capital will reduce and the ability to lower its deposit cost should accelerate in a lower rate environment. But SoFi may also be forced by market forces to lower its coupon rate, which could directly impact earnings negatively. By the way, we're not talking about rates that will come down from 5 point something percent back to 0%. That's not going to happen. Rates will still be quite high. In his view, it would be difficult for SoFi to sustain personal loan originations near current levels without reducing its coupon rate in a scenario where a Fed cuts rate meaningfully given the competitive dynamics versus credit card companies, re-entrance of other competitors to the market, plus consumer expectations for lower debt yield. An acceleration in prepayment speeds represents another risk. By the way, SoFi, right? SoFi was offering higher rates way before the rest of the market were offering those rates because, well, they can do that. The same thing will probably happen here. This is just my opinion. When the analyst published his note to clients Tuesday afternoon, he assumed a $1.8 billion valuation for SoFi Technology business and said that the market was valuing the bank, which was about $30 billion in assets, at about $7.8 billion. For comparison, he pointed out that Ali Financial was valued near $11 billion despite having about $200 billion in assets. Growth rates are certainly different, although we failed to find an example of a premium multiple consumer bank in the market today. He wrote that SoFi's stock remains polarizing, and while the company could be on the road to achieving and maintaining profitability, there are more downside scenarios to this outcome than upside, which at a premium valuation shifts us to a more cautious stance. He also talks about how the technology side of the business, which is Galileo Technicis, will not perform as well as expected. And I found this extremely strange because we already had some positive comments on that in the latest earnings call, which I highlighted here. So the technology platform, it's importantly, as noted previously, we expect the year-over-year growth rate in technology platform revenue to continue to accelerate into Q4 with increased contribution from new partners to the platform, along with greater product adoption among the existing partners. Tech Platform's overall diversified growth strategy includes growth in new vertical segments such as B2B and traditional financial institutions, new products and geographies, and a focus on partners with large existing consumer bases with more durable revenue streams and growth prospects. We know that this part of the business did not really perform as well as the other parts of the business in 2023, but these comments were very, very well received in the latest earnings call. Now I'll continue. They expect the technology platform segment revenue to see an acceleration in Q4 with ongoing strong margins as we leverage prior investments. And as we go into 2024, we should assume that personal loans and student loans will be additive to growth, not the driver of growth. I'll repeat it again for the analyst if he's watching, probably not. Personal loans and student loans will be additive to growth, not the drivers of growth in 2024. Our technology platform business and financial services segment business will be the drivers of growth and will supplement that on the lending side. In addition to that, we are committed to GAAP profitability in the fourth quarter of 2023 and for the full year 2024. So those are the two guideposts to think about, which basically this segment right here just, I won't say debunked, but close to debunks the analyst's bearish expectations. I mean, SoFi has not really given us any reason to doubt management, right? They've been managing this company through ups and downs, through pandemics, through student loan pauses, etc., quite well. I mean, they've even exceeded expectations. So do we really think that they have no clue what was about to happen or what is about to happen in 2024? I think they're very, very well prepared. So right now, if we look at the stock, of course, we got rejected here, $10, or got rejected back at the end of July. Same point, a bit higher, that's true, but same area, around $10. Right now, we are sitting below the 20 and the 50-day moving average. The 200-day moving average sits just under $8. So if you're looking to add better entry, I would say see if it holds above the 200-day moving average. If not, then we have a support here at $6.80. So overall, to conclude, to me, it's pretty simple. Nothing has changed with the business. The stock has run up, that's true, just like many other stocks out there. Is that a reason to turn bearish? No, it's definitely not a reason to turn bearish, especially not with earnings coming up at the end of the month. If earnings isn't as good as expected, if they can't beat expectations, if guidance is not as good, then yes, maybe there could be a good reason for such a bearish note. But as of now, not really worth my attention. But since we talk about SoFi a lot on this channel, I thought I'd share my thoughts here. So hopefully you get some value out of this video. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.